Hey, YouTube family, welcome to the Kevin Strong Show. And in this video, we're going to talk about a couple of things that in the next 5 years, the average middle class family just simply won't be able to afford. Middle class misery. So we're going to talk about that. I'm going to slide over and show you an article and give you my comments about the points that the author brings up that's going to be out of reach for the average American. And then in the latter half of the show, I'm going to get back on track and share with you some financial stocks that I'm looking at. Once again, this is not financial advice. And one of them is headed towards what's called a death cross. And if you've not been familiar with that term or don't know what that term means, by the end of this show, you're going to want to stay tuned and get educated on that, because if you understand options or understand how to make money when the stock is going down, this could potentially be a very, very nice windfall. So without further ado, we're going to go ahead and slide over here and talk about this article that talks about these are the things, ladies and gentlemen, in the next 5 years that the average family simply will not be able to afford. So the first thing they talk about is extended family trips. It says, I would say the tradition of extended family trips, especially overseas, will probably increasingly be something in the middle class can't afford in the coming years. This is actually more profound than what this statement is talking about. This particular statement is specifically talking about extended vacations overseas. I think this is going to have a tremendous impact on remote workers, because so many people want to work remotely now. I think even those jobs are becoming more competitive because the average person, obviously given the choice, would prefer to work from home than have to physically come into the office, thereby creating more demand than the supply for remote jobs. As these jobs continue to contract, as the unemployment rate goes up, and as a result of that, these bigger companies start to lay off and reduce their employee count. I think a lot of these remote jobs where these people have moved overseas is going to affect their standard of living. They're going to have to readjust. Some will have to come back. And in those areas or those countries that primarily rely on tourism or get a big chunk of their revenue from tourism, it's going to actually slow down. So this is talking about families, but I think you can extrapolate from this how this could have a global effect on tourism and remote work. New cars. We all know about this. Vehicle prices have increased dramatically in the past 4 years and will likely continue to be more expensive. So we see that. The only thing I have seen recently in research is that the average cost of EV electric vehicles has gone down substantially. I know Tesla has done a series of price cuts on some of their selected EV models. I don't follow that industry too much, but I know there's been some price reductions in it. But with the exception of that, you can only imagine in the next 5 years that we may get a temporary deflationary period for the auto industry as we are experiencing now. But I think it's only a matter of time because of labor, cost of materials. Those prices for the average car will continue to go back up. Private school tuition rates have been steadily climbing for years. It's highly likely they'll outpace a middle class income in the near future. I think this is spot on. What's also alarming about this is that those families who are a little bit more traditional and conservative, because they feel that let's just put this a little bit more politically correct. The school curriculum in a lot of school districts is just getting a little bit too progressive, for lack of better words, and people are looking for a little bit more of a traditional educational experience for their children, would probably prefer to pull their kids out of public schools and put them in private. But once again, even that's going up in price. The next one talks about home ownership and real estate. I think we're all familiar with this. Honestly, with the way things are going, a mortgage or house purchase might be something the middle class won't be able to afford in 5 years. So I am also on board with this. I think we're going to see in certain markets, not in aggregate, some significant pull downs in the next 18 to 24 months. But by 26, the latter part of 26, moving up to the first quarter of 2027, any markets that have experienced any type of pullback should start to rebound at that time, and then prices will eventually start to climb back up. So the affordability crisis, unfortunately, is here to stay. I do have a little bit of a conspiracy theory about that. I'll try to give you the elevator pitch for that. I am starting to believe, ladies and gentlemen, that the banks obviously want to get some of these homes back, because I forget the exact stats, but I think between like 20 and 22, over 40% of all mortgages were created when interest rates were so low. So I don't know what percentage. It might be over 50% of current mortgages are under 5%. So when you have 30-year fixed rates at 3 and 4% and inflation is going up, these banks can't make any money on that spread. So it's ironic, after we had such a apex in home values, now all of a sudden property taxes are going up out of control. Homeowners insurance is going up out of control. They're squeezing the consumer from both sides to the point where they're going to have to give back these homes, because in the long run, as I mentioned earlier, it's just not profitable in today's inflationary environment for a financial institution to carry millions of loans at 2 and 3%. But that's just my little tinfoil hat. The next cost is healthcare. These expenses have been rising steadily, outpacing general inflation rates for years, and there's no sign of this trend reversing. You guys know how I feel about this. I think too many men and women are so quick to brag about how much money they're making on Instagram and Facebook. But I'm going to say this again. Health insurance is not health care. I don't care how good your premiums are. I don't care how low your deductible is if you don't have health care, which is preventive maintenance. You have to exercise. You have to eat somewhat healthy, because at the end of the day, we all want a quality of life as we get older. And if you ignore that, there's always a price to pay, if not sooner, then later. The next topic is leisure and travel and retirement. For those looking to retire in the next 5 years, here's another problem. They're talking about the rising costs and inflationary pressures affecting everything from airfare to accommodations and dining. Tourism, once again, kind of leads into this, and obviously that's going to start to slow down. I think you're going to start to see airline prices slow down in 2025 as demand starts to pull back. People just don't have the extra discretionary income for leisure and travel. I think a lot of restaurants, as you guys know, are starting to pull back, and you start to hear places like, I think Big Lots was talking about filing Chapter 11 or closing a bunch of stores. I think Dollar Tree just had a recent stock report, and I think their stock had went down, I forgot, 15 to 20%. So you know things are bad when discount places still can't make any money, because normally that's the last path that most people who need something affordable, that's where those people go to shop. Safe investments for retirees. Traditionally, he said, this is the author talking about this, bonds and fixed income have been seen as the cornerstone of retirees' portfolio, providing both income and stability. However, with interest rates at historic lows and inflation on the rise, he said the real return on these investments may not keep up with inflation. So when the Fed starts to cut in September, that basically means the economy is doing worse, and it's going to get much worse. As a result of that, it may be a little bit tougher for you to get that guaranteed rate of return, because inflation eventually is going to start to creep back up. This is one of those things that I've talked about ad nauseum. You must continue to find a way how to beat inflation. Learn how to trade stocks. Learn how to do. There's a lot of things you can do financially in the stock market that are not necessarily high risk. You know, you can get into dividends, stocks that pay you dividends. So there's a lot of alternatives that you can get into, but it requires you to take up the time and effort to learn those type of things. So that's going to be it on this side of the thing. I'm going to briefly slide over and share with you what a death cross is, and then we're going to finally finish up the video with the stock that I went with Friday. So for layman terms, a death cross is when you have a 50-day moving average and a 200-day moving average. The 200-day moving average should be below the 50. When the 50 crosses below the 200, that's typically a big signal that the stock is going to go down in a big way. This is a technical analysis called the death cross as it applies to stock. So I'm going to share my screen, show you what a death cross looks like, because for those of you who visually need to learn it, you'll probably get a better illustration of it seeing it on a graph opposed to me just verbally telling you what it is. Let's see. 1 second. Okay. So let me give my screen a second to adjust here. You see my mouse up here? This red line, I don't know how visible it is, but this top line is the 50-day moving average. This bottom line here is the 200-day moving average. So the 50-day moving average, which represents this red line, is taking into account the last 50 days, taking all those stock prices at the close, add them all up and divide it by 50 to get a 50-day moving average. The same math is applied to the blue line, but the blue line represents a 200-day moving average. So in this example, you take 200 of the closes on the stock market prices, and then you divide that by 200 to get the average price based on a 200-day moving average. So obviously, a 200-day moving average, there's a lot more into that than a 50-day moving average. And that's why the 50-day moving average should be higher than the 200-day moving average. What you're seeing here in this example is that when the 50-day moving average crosses the 200-day, it takes a long time for that to happen, and it doesn't happen too often. So normally when it does, it's not 100% accurate, but normally when it does, it indicates that that particular stock is going to go down, and it's going to go down in a big, big way. So I'm going to give you the stock that I think potentially could enter into a death cross, and then I'm going to give you my recommendation for the stock I went with on Friday and some other things that I am looking at. So give my screen a chance to adjust here. This is CrowdStrike. And I know a lot of you guys are familiar with this. A couple of weeks ago, several weeks ago, this was the infamous stock or tech company that had some type of, software, at least purported to have some type of software update that caused all these technical glitches that affected the airlines across the country. Delta got hit the hardest out of most. So the stock was really, really up. Let's see here. I know I shouldn't have done that. 1 second. A while ago, and now, of course, this is Murphy's Law. So let me put this thing back in here. 1 second, guys. I should have not have messed with this. Okay, I'm not going to mess with it. It was up a while back. This green line, see my mouse here? This green line, this is a 200-day moving average. You can color code these any way you want. So the example I gave you, I think it was blue. Mine's green. I just wanted it to be green. This green line is a 200-day moving average. This yellow line, you see above it, it's the 50-day moving average for CrowdStrike. And as you can see here, it looks like what? This yellow line, which represents the 50-day moving average, is getting ready to cross the 200-day moving average. If this happens, and we get confirmation that it physically goes and closes below the green line, you have what's called a death cross on CrowdStrike. I think technology stocks in general are still under a little bit of pressure. So this is something to watch out for those of you who follow options and know how to buy a put. This may be something that you want to put on your watch list in the next 7 to 10 days, but this may not play itself out. It may kiss that and roll back up. Volume seems like it was okay, but you never know. You would wait for confirmation. The RSI is not indicating that it's getting ready to roll over, but like I said, the most important thing to look out for this particular example is to see if that yellow line goes below the green. So what stock did I go with? I just made one stock pick on Friday, and I did what's called a bear call, which is a bearish or negative bet on a particular stock, my stock symbols indicated that target, the symbol TGT, is going to continue to go down. I think I took this contract out for about 8 weeks. So you guys know how I do this. I'm normally only in these trades for a day or two, and I'll probably close out of that after hours. I forgot where it's at, but I'm pretty confident this will be a profitable trade. This yellow line, once again, is the 200. This green line is, I'm sorry, the yellow line is the 50, and the green line is the 200. So this ironically could be almost like a bear flag for those who understand technical analysis. But once again, I'm expecting this thing to dip down a little bit more. It may not come all the way down to its 200-day moving average, but those who understand options know that I only need this to come down a little bit from like 153 to like 152 to make like 20 or 30% on my money. So I'm not expecting a big pullback, just a minor pullback. So wanted to make sure that I did some stock stuff. Like I said, this is not financial advice. Please do your own due diligence. I'm just sharing with you my stock picks and what I'm looking at. And CrowdStrike is definitely on my list as it looks like it's approaching the infamous death cross. So that's going to do it for this edition of the Kevin Strong Show. Please take care of yourself. Like I said, keep in mind, ladies and gentlemen, I cannot say this enough, especially as you get older. Health insurance is not health care. You have to take care of yourself. So if you're new to the show, welcome. If you enjoyed this edition of the Kevin Strong Show, do me the honor of leaving a comment and hitting the like button, and also consider subscribing, because I typically release my vehicles. I particularly, or usually I should say, release my vehicles. I can't even talk. Release my videos. There it is. There's the word. I must have been watching the show or something. On Saturdays at 11 o'clock Pacific Standard Time in the morning. So sorry about the choppiness at the end, guys. Thanks for hanging to the end of the video. Please like, share, and comment, and I'll see you in the next one. Take care.